Joining me today is our managing partner, Mike Manning, and a distinguished panel of NEPC professionals to walk through some more specific client questions relevant to each of their different client segments. But really, we're gonna try to provide relatively quickly perspective on the recent market volatility. Mike's going to provide an update on NEPC and how we're prepared to continue to work with our clients in the event of a larger disruption. And then we're going to hand it over to a panel, to really talk about, hopefully some, deeper dive questions relevant to, practice groups, segments, and maybe even some operational issues some of our clients may experience over the course of the next several weeks. So just a quick disclaimer on logistics. We're going to make these slides and the webinar available on our website. In addition, we've recently published a blog that was posted on Monday, so feel free to review that as well. We encourage you to ask any questions and type them into the question box for the webinar. We'll take some time at the conclusion of our prepared remarks to walk through those as well. So with that, why don't we get started? We'll walk through some of our thoughts. I think the first piece, just to emphasize, just to take a step back, is the last couple of weeks have clearly been an eventful period for both markets and also changing health conditions, of which we probably haven't seen for many of us in a very long while. And it's an uncertain market environment, and I think the piece we really want to emphasize is, in the face of uncertainty, is remaining disciplined. There's no clear buying opportunity we see to stepping into equity markets, but we really want to emphasize we all have long-term plans, we all have strategic objectives. Let's keep to those, and should the market provide an opportunity, we'll definitely come back to you with our thoughts. I think in terms of market activity for the last week or so, I think this is not a surprise to many of you. Over the last 7 days, we've had quite a bit of market volatility where we've seen equities sell off, a rally in safe haven assets, especially treasuries, and also pretty significant sell-off in the commodity sector as well. Much of this can be traced to kind of the now global footprint that we're seeing with the spread of the coronavirus. As cases rise, in many countries, and also the number of countries continues to increase. I think what we've observed is, really the catalyst over the last 5 to 10 days that spurred, I think, a lot of this market dislocation is, as we saw a number of daily cases outside of China increase to a point that there were more cases occurring on a daily basis outside of China than there were in China, and that really seemed to persist to motivate a pretty dramatic kind of vol uptick and shock to market volatility. I think the other piece that you'll hear a lot about and probably read quite about for many on your own is comparing coronavirus to other past outbreaks. So when we think about SARS or MERS or others, and really we're not looking at a comparable metric here. And we're approaching probably over 100,000 cases that we'll see globally over the next several weeks. This is new and unprecedented territory, but I think also to emphasize, historically these are more short-term episodic events, and markets, and as humans in general, we tend to kind of really look to the worst case scenarios. And I think maintaining that discipline over the next couple of weeks through some of the price activity is a really important piece. I think, in some ways the picture is worth 1,000 words, but as we look at, what's the possibility of, larger containment, larger quarantines, really anywhere in the world, we can look at some data that we've seen in China. And I'll just take a brief moment to kind of explain what we're seeing here. On the left-hand side of this graphic is the emissions of nitrogen dioxide over China from January 1st to January 20th. And you can see kind of that reddish orange hue, over Hong Kong and also kind of the Beijing, Shanghai area. And over the course of the last several weeks, you can see on the right here kind of the dramatic shift that we've seen there. I mean, this is at its simplest, economic activity actually can be measured pretty easily in emissions. And this is one where you've seen a really drastic decline in those emissions. And this is everything related to car emissions, buses, factories. Everything clearly has been, shut down in a fairly aggressive fashion that, frankly, probably helped, slow the spread for the rest of the world. We're seeing China start to pick up some of their economic activity, but I think, should we see, a harsher containment measures, whether it be in South Korea, Italy, or anywhere it might be, these are some expectations that maybe we should have in terms of how that might impact economic activity over the short term. A couple of other points we want to mention, when we think about the hotspots, it's really China, Japan, South Korea, and most recently, Italy. And we really want to share, when we think about, the Asian economies, they really are interconnected, it's both from a supply chain standpoint and a trade standpoint. And, whether it's an issue in China, South Korea, or Japan, it really affects all of kind of the Asia block of economies, whether it's Vietnam, Philippines, Thailand. So it will have an economic cost. And I think the big question that's outstanding that many have is this a short-term or a longer-term component? And I think as part of that, I think, a lot of us are trying to understand what is the tail risk or the tail of, economic impacts that we might see. And I think one thing that, we potentially can look to is, the scale of global tourism. Clearly, travel is going to be a bit impaired for many over the course of the next couple of weeks and over the next month. And China and the U.S. are the biggest spenders internationally when it comes to travel and tourism. I think many can expect this will be slower in 2020 than it was in 2019. Will it be a lasting impact? How does this kind of cascade through the economic system? I think these are all the type of questions that we, frankly, will just have to wait and see. And I think the other aspect that is maybe not a bit unusual, but I think surprised many of us, is the Fed's recent action in terms of a 50 basis point rate cut yesterday. And this is one where there is a history of the Fed stepping in, especially in emergency meetings, to make a 50 basis point rate cut. The most recent period was, the 2008 times, with clearly, preceding the financial crisis. And the other was, after 9/11 in 2001, where the Fed, essentially had an emergency rate cut just to hopefully smooth out economic activity. The thought is that was, their plan, with this most recent rate cut yesterday. But the markets are continuing to project, further cuts. Will we see another 50 basis point cut over the course of this year? That seems like that would be a surprise, especially in an election year where the Fed is typically hesitant to get in the way of politics. But we're, frankly, walking in slightly uncharted waters here. I think the piece that, really hits home and is a bit of the, I think, a slight market action that we're going to be suggesting to folks is really related to fixed income and safe haven fixed income exposures. We've seen, Treasury yields, especially the 10-year, drop to record lows. The 10-year Treasuries hit in certain points under 100 basis points over the last several days, which is clearly, forecasting, a flight to quality and concerns about what's going on globally. But as we look at it, and as we've looked at exposures and other areas of our clients' portfolios, suggesting a bit of a pare down, taking some gains from these fixed income segments, we think makes sense in the current market environment. In terms of some other movements we've seen, typically when we see large equity drawdowns, one thing that we try to look to is how are credit markets reacting. In some ways, equity markets are the most fickle and quickly feel pain and fear. Credit markets tend to be a little more reliable historically in terms of, should we have a real concern here, or is this a slight kind of episodic event? And I think from what we've seen in various segments in the high yield space, a slight uptick in credit spreads, but not one that's, I would say, highlighting material concern. And I think in many cases right now, credit spread movement is almost directly associated with some of the concerns for the energy-related companies. I think a big question mark is commodity prices are down. How long will commodity prices stay down? If you think in the energy sector, how long can some of these companies and triple C and single B level credits survive at oil under $50 a barrel? And I think one of the big things that we're thinking about is how do we assess the economic impact? And in a situation where you don't have real historical parallels to look to, I think all of us have tried to look to kind of some different metrics. One here is a World Bank study from several years ago. And it's a bit of a thought exercise, but really what the World Bank tried to do was think about what are the costs from an economic standpoint associated with a pandemic. I mean, clearly there's a human cost, which I think we're all, thoughtful about and concerned. But from a pure economic cost standpoint, that's typically the minority or the smaller impact when it comes to kind of broad GDP growth rates. And their estimate, the biggest source of economic disruption comes from what they would call efforts to avoid infection, but really comes down to containment and quarantine. And so if you think back to the pollution emissions chart graphic that we had when we opened, that really highlights how dramatic of an economic impact that we can see from these quarantine and containment efforts. And I think most people are expecting a very low number out of China for their first quarter GDP print, and I think it's fair to assume that'll spread to other parts of the globe as well for Q1. I think some other things that we're thinking about is relative to this unknown. Is this a short-term economic impact, which is analogous to what we might see in a natural disaster, whether it's a weather-related, earthquake-related, or other related event? Typically, it's a short-term economic hit with a corresponding rebound as the supply and demand gap is taken back up. I think one of the big question marks, will the coronavirus spread have a more lengthy impact in consumer consumption patterns? There's an aspect of the invisible hand that flows through all economic activity that's hard to know until you see it. And this is part of the reason why markets are moving as they are, because they're trying to discount and properly assess some of the probabilities and tail risks that could happen in such an event. And I think part of that really comes down to the fatality rate that we're seeing related to confirmed cases is roughly around 3%. So a broad kind of global spread of the virus, would have a relatively severe economic disruption. Can it be contained? Does it die out in the summer when the weather heats up? Is another point that would help. I think forecast maybe this would be a shorter term economic event. I think part of these economic events you can see some of the data already starting to flow through. Just looking at the U.S., Japan, and South Korea. Slight trends lower over the last month, but really you see a huge drop off in the PMI numbers from China's manufacturing segment, where if you think about a number of 50 is really highlighting, anything above 50 is highlighting an economic expansion, below 50 is highlighting a contraction. So moving from what is kind of the low 50s down to a number that's in the lower 40s is a really severe drop down, which coincides with the fact that much of the country was shut down for the month of February. I think one thing that just want to leave as a takeaway and for folks to consider is when we think about the most recent drawdown that we've experienced, roughly 10 to 15%, let's view it more in context of the market movement for the S&P over the course of the last 12 plus months. We've had a tremendous rally from U.S. equities in 2019. So absent any sort of external news story, market corrections isn't a surprise. And so I think what we've seen today is frankly more along the lines of a classic correction, and view that in line with the gains that we saw last year. And I think a couple points before I hand it over to Mike is, what are some things we should be thinking about? What are some expectations for the coming weeks? I think there's some things that we're more confident about or we have more certainty over. I think one is, this is COVID-19 is likely to be, officially labeled a pandemic by the World Health Organization. I don't think that's a controversial statement at this point. The number of confirmed cases in the U.S. likely to rise. I think preparing for that that possibility and how the market might react to that is, I think, important from just an investor behavior, investor psychology standpoint. And as we kind of speculate farther out and how might the market adjust to some of these news items, we'd expect volatility to remain elevated across equity and fixed income markets. Especially as, whether it's investors, the market as a whole, trying to find that pricing mechanism to understand what's the real tail risk here. Is it too low of a probability or too high of a probability? And time will tell on that. I think the other piece to really emphasize, first quarter GDP growth rates, whether it's China, whether it's US, whether it's in Europe, are going to be low. And are they transitory low, or do they pick up in a corresponding fashion for the next quarter? And then as we think about what's the likely response, we've seen central banks in China, US, some other parts of the world react already, but have yet to see what we'd call kind of a coordinated fiscal response. And should conditions worsen, I think that's something that's very likely to occur, or at least being discussed about a potential policy response from central government. I think last is probably the piece that we're most comfortable saying is these expectations will evolve, and there's a significant level of uncertainty around the coronavirus impact, but we're continually monitoring the situation, and as the market environment changes, as health conditions change, we'll continue to provide an update for you all. So with that, I'm going to turn over to Mike to talk about some suggested next steps for clients and also a quick overview for how NEPC is prepared.
Thanks, Phil. In terms of next steps, just a reminder that you can ask questions through the webinar feature. We've already got a handful of questions from people, so thank you for that. And we're going to get to questions here in just a minute. So in terms of things to do from an investment standpoint, I think as Phil mentioned, we've seen a huge spike in the returns from fixed income assets, safe haven fixed income assets. And our thought is to try and realize gains from those as part of rebalancing the portfolio a little bit. And one thought is actually to keep an extra month of cash on hand just in case, both as dry powder, and in the case if markets get closed for whatever reason, to be able to have additional flexibility. The cost of holding cash relative to other fixed income securities today is it's a pretty flat yield curve. So we think that is an appropriate strategy. That said, we don't see a lot of clear opportunities or opportunistic buying opportunities. I think Phil pointed out that while the market has been down from the peak about 12%, in the context of the last 14 months, it still had a very strong rise during that period. And even in the year of 2020, it had gone up quite a bit before the most recent sell-off. So, no screaming buying opportunities for us. And we think that the approach of maintaining discipline in terms of rebalancing and keeping those long-term targets is the appropriate strategy. And always you hear this from us quite a bit. We think it's important to embrace diversification. 2 months ago or 3 months ago, I don't think anyone would have expected that we were having a call to discuss a potential pandemic, but that is why you build in diversification into your portfolio so that you can have different parts of the portfolio that will react, we hope positively, to certain market environments and to balance out those areas that are areas of weakness. So that's from a portfolio context. We'll get more questions and answer more specific details in a minute. But just in terms of NEPC, I sent an email out earlier this week. We have existing business continuity plans where we've been able to operate during past disruptions. Most of those were localized, a blizzard in Boston or things like that. But we do have a lot of experience dealing with this. Some additional steps we're taking. We're postponing international travel for the time being. We're asking employees to limit non-essential travel, including trying to do our meetings with the manager community more virtually, either conference or video conference calls, and then even slowing down travel for internal NEPC meetings. Obviously, the meetings with you, our clients, are essential, and we will continue to make those, but also understand that many organizations are trying to curtail both travel from the organization and then in some cases to the organization. So we're here to help facilitate and set up virtual meetings if that's the appropriate choice for you. And as I mentioned before, we have a lot of folks at NEPC who work remotely anyway, and we're actively testing the ability for all of our employees to do it, again, just if there's a worst case scenario. So, again, we think we're trying to proceed with an abundance of caution here, and we're still planning to host our annual client conference in May here in Boston, but as the situation changes, we'll continue to evaluate that, the decision to hold that conference. So from here, I'm going to turn it over to Chris Lavelle to introduce our panelists and to start taking some of your questions. So, Chris.
Great. And I wanted to thank all of you for participating in this webinar. When we sent out the invite last week, I seen that my mailbox has been flooded with these sorts of webinars across the investment management community. And I really appreciate that you called into ours. We hope it's been instructional so far and that you've gotten something out of it. We thought to kind of differentiate from what other folks were doing that it made sense to get really some different subject matter expertise across NEPC to speak to things that they see in their particular areas. And so on the panel today, we have Karen Harding, who's a partner who leads our private wealth initiative, but is also somebody that can speak to how the things we've talked about so far in market disruption really change things when you're a taxable investor. We have Lena Asenio, who is our Director of Portfolio Services, and really comes with an operational bent that I think is really important in times of disruption and dislocation. She has lived through a lot of operational challenges for all kinds of things, as Phil mentioned, and so I'd like to ask her about those things.
So to be clear, not at NEPC.
Yeah. Yeah, everything has been completely fine at NEPC. And then Shanae Edwards is a senior consultant in our healthcare group. She was also in our endowment foundation practice earlier. And the opportunity here is to really look at, we know that our healthcare clients, first of all, are dealing with this issue directly, but also they have multiple pools of assets that may have different approaches. So with that, I'd actually like to ask that very question to Shanae. So hospitals will be on the front lines in fighting the virus. In addition, as I just said, they have multiple tools to manage during these disruptions. How will NEPC work with healthcare clients in addressing COVID-19?
Hello, and thanks, Chris, for that question. I think the first thing to keep in mind, NEPC will be very proactive with working with our healthcare organizations. We also recognize that each healthcare org or hospital system is unique. However, most of them have a few common investment portfolios, and I'll walk through some of the key considerations and areas of focus as we think about what they should be doing now. So as it relates to their operating assets, we think that liquidity is a key area of focus, particularly considering how their cash needs may increase due to their ability to address the COVID-19 virus. So they may have more staffing needs and have to pay more in overtime, or they may need new supplies to actually efficiently run their operations. And so our view is that clients should think about their operational assets, particularly their cash needs, and create a buffer in the near term if that's necessary necessary to think about what cash they will need over the next few months, really to support operations. As it relates to their defined benefit plans or pension plans, we think that particularly those clients that have LDI, they should, think about the structure of their program, think about their glide paths, revisit them, and evaluate if they've met any triggers and need to kind of move to a different point in the glide path. And lastly, most of these healthcare organizations also have defined contribution plans, and I think our view there is pretty simple. We think that no action is necessarily needed. Stay the course and really remember that you have a diversified strategic long-term allocation in most of these DC plans.
Thanks, Sinead. I think our next question is for Lena, and speaking to that operational fund, we know that from past disruption, the key service areas can face delays. From an operations perspective, what are considerations and actions to plan for right now?
Thanks, Chris. You raise a concern that as a leader of an operational business areas, I think about all the time. And for us, the three things that I think about that we're planning for are really around our process, our business continuity, and then just preparation. So from a process perspective, I think for us, we have a robust operational process, and we're really focused on having strong oversight over our controls and what we do, so that when there are issues, we can really go back to those, what are the procedures, what are the processes that we have to execute on, so we don't have any major issues. And that also plays into when, you have potential loss of staff who cannot work because they're ill or because they're, caring for others. And then from a BCP perspective and the business continuity perspective, it's really about, how would we plan for different scenarios? And those are things I know Mike alluded to, but, we've done more detailed work on the operations team about, okay, if we have half the staff, how many people do we really need to get the job done? What is that minimum requirement? And doing that across the organization, I think will prepare us so that if we have to go down that path, we're ready. And the final thing I would say is just preparation. From our perspective, we do a lot of things, but one of the things that we support is the OCIO trading process. And so we're really focused on that in terms of making sure we have data available for our portfolio strategists so they can take action and take advantage of any potential market dislocations in the future. So it's, what's the information that we need and how do we get it to people that need it? The other piece from a client perspective, I'd say, if you're thinking about preparing and thinking about your staff or people being in different areas, and when you think about cash as an example, again, Mike talked about this, is do you have authorized signers? Do you have people authorized to trade cash on web portals, custodian portals? Who are those people, and do you have backups? And maybe now is the time to come up with, what are those 1-2 key people that could do that for you if you have a small organization?
Thanks. Karen, sorry, I introduced you first, and I asked you the first question last. But for taxable investors, how does recent volatility impact expectations, but also opportunities?
Yeah, thanks, Chris. Great question. For taxable investors, the hurdle to do anything with a portfolio is always a little bit higher because there's generally going to be a taxable implication for any change that you might effect in the portfolio. So it really does give us a chance at a moment like this to really go back and reaffirm goals and objectives, because we're typically dealing with multiple asset pools, and they'll often have different time horizons or different cash flow needs and things of that nature. So we're typically going to treat them differently. When it comes to opportunities, the marketplace opportunities that we'd be seeing for taxable investors would be in line with those that we would see for all of our clients at NEPC, and we've talked about some of those previously. So I'll focus my comments more on how that would directly impact a taxable investor. So when we see volatility like this, in some ways it actually does have a silver lining for a taxable investor. For example, when it comes to rebalancing, and we continue to reiterate the value, I think, of diversification of rebalancing within portfolios, but for a taxable investor, sometimes rebalancing can be a challenge because you have to pay the taxes on anything with embedded gains when you make those changes. So when you're looking at the portfolio, and let's say, for example, you have a manager that you like, but perhaps there's another manager you like better. In a tax-exempt portfolio, you might not think twice about making that change, about upgrading that manager at any point in time. But for a taxable investor, a time like this actually gives you a much better opportunity to make that trade because you're doing a like-for-like swap in terms of your market exposure, but you're able to do it at a lower valuation when the gains implications are going to be smaller from the tax impact. It also gives you some flexibility around tax and estate planning. For example, if you're thinking about gifting within the family dynamics, you're able to do that with lower valuations today than you could for 2 weeks ago. So when you're thinking about valuations for gift taxes, that could be very beneficial. Likewise, when we continue to see rates coming down, with the unexpected, 50 basis point cut earlier this week, those rates ultimately trickle through to the applicable federal rate or the IRS discount rate, and those are the rates that are used to set all types of valuation metrics when establishing charitable trusts and other entities of that nature. And so a lower rate there can also be beneficial. So there's absolutely a silver lining to this type of market correction for a taxable investor.
Thanks, Karen. I want to get to a few more questions before opening up for broader questions. Lena, another question for you. How does this level of market disruption, how are you handling it for NEPC discretionary mandates?
Well, there certainly has been a lot of excitement on the discretionary team, I would say, from a trading perspective. But in general, really, for our OCIO mandates, we are following the recommended approach that Phil outlined, and we're paying close attention to our client portfolios on a daily basis. So because we can look at our portfolios every day with daily valuations or proxies relative to our client targets, on a daily basis, we understand what those look like. We've been active in raising cash, so we did some of that last week for fixed income, and we're doing another round actually today in terms of selling some short duration bonds to be ready for the, again, opportunities or cash on hand should we need it, should our clients need it for unexpected expenses.
Great. So I think Phil is going to direct some questions that have come in online, and please, if you do have additional questions, we're still adding to the queue. We have up on the screen a focus on our client conference, as Mike said, still scheduled for May, and if things proceed as they have in other pandemics, we could have a short event here, and then things return to normal. And we'd love to see you in Boston. We've got some great speakers lined up, and I'll look forward to and hope that you look at your email for information on signing up.
Great, thanks, Chris. And I think the first question we'll toss back to you, related to the recent drop in interest rates and potentially more volatile outlook when it comes to economic growth. How does this inform, potentially our capital market assumptions and also kind of the typical institutional investor's portfolio?
Thanks, Phil. So we have had the discipline for many years to develop our assumptions on an annual basis, recognizing that every year has some level of volatility. And as you've already heard, the level of market correction we've seen this year is actually a pretty commonplace occurrence. We don't want to have a hyper-reactive process that radically changes our assumptions based upon the data points that occur in the course of a day or a week. With that said, we meet continuously in the asset allocation team and committee, and we have formal meetings monthly and quarterly to go through markets. And for those clients that have been with us a couple of years, you may remember we changed our process at the beginning of 2019 because December 2018 was such a strong correction that we felt the need to update our assumption sets. So those are conversations that are going on right now, especially I think with the level of interest rates in the U.S. being at an all-time low for treasuries. We may come out with new assumption sets if this lower for longer is lower and longer, as we've seen this past week. But as we've also seen with the Fed action yesterday, there's a reaction from things like the virus, and then there's a counter reaction by monetary and fiscal groups. So we're going to be cautious. We're not going to jump in it. We will certainly be looking at a mark at the end of the first quarter at 3/31 to see what our process would say in terms of forward-looking assumptions. And, the more news to come there if this is something that we feel the need to truly update based upon a sustained market reaction.
Great, thanks, Chris. Last question that we received, I think also helpful just kind of reiterate our views on market conditions. Question came in kind of what are our thoughts about how we're positioning portfolios, especially to maybe either take advantage or kind of exploit market dislocations for the benefit of long-term performance. And I'd say first and foremost, still very much urge folks to remain disciplined, stick to kind of long-term strategic guidelines. That said, should we see a material reduction in equity prices, we'll come back with an additional message related to rebalancing into equities, even potentially adjusting allocation should we see a large enough drawdown that supports, we think, potentially a higher equity allocation. We're not there yet. I think to reiterate from Mike's comments, encourage folks to kind of take gains down from the fixed income space. Often, the simplest rebalance approach is to, sell down positions that have, outperformed your expectations, and over time look to buy into positions that have underperformed expectations. And I think that's a good plan, on a go-forward basis. So with that, that's the conclusion of our, prepared remarks. We will make this available to you all on our website, both the slides and a recording of the webinar. We anticipate over the course of this year, we'll have more planned webinars. For example, we'll likely have one in November following the election. And if we see more unplanned webinars related to market volatility, wherever it may come from, you may see those as well. And I kind of emphasize again to all that, as we see, markets adjust, we'll continue to monitor the situation and provide any updates should we see fit related to portfolio adjustments. So with that, thank you all for joining. Thank you for listening in, and thanks for your time.